You ever wonder how we as advisors build ironclad investment portfolios that achieve your retirement goals? Well, I'm going to tell you right now. Hi everyone, welcome back to my classroom. My name is Thatcher Taylor. I'm the owner of ProPath Financial. One big element of my comprehensive retirement plan and financial planning is the investment portfolio. But it's not as interesting as you think, because I build portfolios for goal achievement and for long-term growth and success. I do not gamble your money away. So I want to make sure to give you all the tools so you can make sure you're investing the right way in your investment portfolios. And I'm going to tell you how I do it. All right, the first thing you need to do is you need to clearly define your goals. Defining your goals helps us avoid mistakes. If there's a big decision that comes up, we can always revisit. Does this help you get closer to your goal, or does this pull you back from your goal? So we need to set clear goals before building a portfolio. We need to divide those goals between short-term, intermediate-term, and long-term goals, because those different time frames are going to delineate how we invest different assets. And you need to quantify these goals in terms of money and time. I want a second house in retirement. It's going to cost me X amount for the down payment and X amount each year until I pass away. I want to fund college education. I need money for a down payment in 5 years. I need to pay some taxes or have a big tax bill. These are all different types of goals that have time and amount attached to them. Number 2 is a risk tolerance assessment. The only reason I am mentioning this is because risk tolerance leads to asset allocation. I don't do any risk tolerance questionnaires with my clients, but this leads to an asset allocation, which that asset allocation leads to expected returns. Risk tolerance role is for portfolio construction, like I mentioned. There could be conservative, moderate, and aggressive risk tolerances and some gray areas in between. To help guide you in your risk tolerance questionnaire on how you should develop your portfolio based on how much stock and bond you should have in there and how much cash, is ask one question. If you had $1 million portfolio and in 1 month it was worth $700,000, how would you feel? The answer to that question guides you into what type of investment portfolio you should have to be able to weather short-term volatility. This leads us to the asset allocation strategy that I mentioned before. So once you have an idea of what your risk tolerance is, a general idea, it helps you decide if you want a 100% equity and 0% bond asset allocation, or if you need a 0% equity and 100% bond allocation and a lot of cash in between. That will help develop your investment portfolio, and when you have existing money and new money coming in, where it should be going and what type of asset class you should have. Because a 100% stock and 0% fixed income, or vice versa, or a 60-40 stock to fixed income portfolio, they're all going to have different historical return measures. You need to understand which one of those return measures is going to achieve those goals, and that's how we cultivate the asset allocation. The next step, number 4, is diversification. Diversification is key. That's not holding all your eggs in one basket, not having them all in large cap growth, not having them all in domestic, maybe some international, different types of bonds, some real estate or real estate investment trusts, some small cap, some technology, a little bit of everything, maybe some dividend payers. That's diversification, because they all function a little bit differently over time, and you need to make sure you diversify properly. So just to recap thus far, we're going to define your goals, we're going to develop your risk tolerance to create your asset allocation, and then we're going to create diversification. You need to clearly outline those items if you're doing your investment portfolio on your own. Number 5 is now we start to research and select investments that start to fit those categories. How are we going to cultivate a portfolio? And let me just tell you, your portfolio may be a 2 to 3 to 4 investment portfolio. Could be 4 ETFs or mutual funds that achieve your goals. It does not have to be an elaborate 50 or 60 stock or holding portfolio. In fact, that's most likely detrimental. Having less in this case is more when we develop really high quality ironclad portfolios. I know people think it needs to be some elaborate process, but let me tell you this. The majority of actively managed funds that try to beat an index underperform the index because they get too complex. It doesn't always help you out. So some popular options for asset allocation and diversification and long-term goal achievement can be mutual funds, ETFs, index funds. Stock and bonds are okay if they fit into the proper allocation, the proper portfolio, and you have a good strategy attached to them. All right, number 6 is you need to consider tax ramifications. With investing, there can be tax ramifications, especially in a taxable account like a joint account, an individual account, or a trust account. There could be taxes in that year, but they're not completely taxed. It's just going to be capital gains if you sold anything, dividends or interest, or phantom capital gains from your investments. That's if you use actively managed mutual funds that have a lot of turnover. You can also use tax advantage accounts like IRAs, Roth IRAs, and 401ks to defer taxes until later. Make sure to check out some of my IRA videos here. You can see a bunch of them where I start to dive deeper into IRAs and tax deferred accounts. And then lastly, you want to consider asset location, where within these different account types, there's basically 3 account types: taxable, which we mentioned, tax deferred, and tax free. You want to put different assets in these different account types. That's called asset location, which make sure to like and subscribe, because the next video after this one is going to be the asset location video, where I dive in deeper to asset location and how it helps your tax ramifications. Number 7 is to stay informed and patient. You need to continue to do research and understand what investments you have and what the market is doing. I don't want you to trade every day, but you have to have a good understanding of the long-term potential of how your investments are operating, and then be patient. You do not want to overreact to short-term volatility. We heard all last year that a recession was coming. I see no recession. Be very careful of everyone catastrophizing in the media. That's going to potentially hurt your portfolio in the long term. Number 8 is you need to review and rebalance regularly. Sometimes that's annually, depending on your goals and your strategy, your age, and what you're looking for. Sometimes that's quarterly. Sometimes that might be a little bit more often, but usually quarterly rebalancing is just fine. And what rebalancing is when you build your portfolio, each holding is going to have a specific percentage or holding amount in relative to your entire portfolio. If one investment outperforms other investments, you need to sell and rebalance to make sure your portfolio is built to achieve those long-term goals. If you have an allocation that's 70-30, but certain equities pushed you to an 80-20, you need to sell some equities and rebalance the bond to keep that 70-30 asset allocation based on your risk tolerance. And then number 9 is monitor and adjust. You need to make sure to watch your portfolio. You don't need to check it out every day, but keep eyes on it to make sure that you can make adjustments on your portfolio so that you know what you're doing and you're staying on track for your goals. Because remember, time continues. So you need to make adjustments that if a short-term goal is coming in 1 to 3 years, every year you're getting closer. If your long-term goals are still years out, you're monitoring and adjusting the time to achieve those goals and the amounts to make sure you're staying on track. So let's summarize the last 5. You're going to research and select investments. You're going to consider all the tax implications. You're going to stay informed and patient. You're going to do regular reviews and rebalancing, and then you're going to monitor and adjust as needed to keep you on track with those goals. Those are the 9 things that are really going to help build a portfolio. It's a lot. When you start going through this list and start thinking about all the elements that are going to apply here, all the words that I put up on the screen, you're going to see that there's a lot that goes into this portfolio. You can do it on your own. It just takes time. If you don't want to do it, that's when you hire a person like me or another financial planner, hopefully a fee-only fiduciary that's going to help invest to achieve your goals. If you have any questions, please feel free to contact me. If you would like a free consultation, hit the Get Started link below. Can't wait to chat with you. Thanks for watching. Make sure to like and subscribe. I appreciate it.